to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Yes, Bullington Capital. Yeah, you can go right to the website. And in fact, you might want to go there and sign up for the seminar that's next Saturday morning, where we're going to be looking at different ways that you can try to control the amount of taxes you're paying. I think got quite a few ideas for you. Been working on it for, a couple months now. And I think you'll be pleased. We're going to be talking about a lot of different things, a lot of the tax law changes, how you might be able to reduce taxes while taking income. That's kind of an interesting concept. And it's all tax avoidance, by the way. It's not tax evasion. Those are two different things entirely. One will get you thrown in jail. The other will just reduce your tax bill. So anyway, so you can go to my website, bullingtoncapital.com, to sign up there online. And, I started putting out a bi-weekly email, and you may want to check that out, too, if you can sign up for it. Actually, you just have to tell us that you wanted it right now, because there's no sign-up page for that. And I go through articles that have been selected by a company that has licenses with all the big media outlets. They select the articles that they feel like are most pertinent to a financial planning practice, and then we pick the ones that we want after we've read them, and then we send them out. And a lot of them are really helpful. So that's something that we just started. I think it's only been a few weeks, actually. And so we've probably only got 2 or 3 out there so far. And if you'd like to see that, we'll be talking about that at the workshop. I know I've done this in the past. And by the way, I bought every adapter on the planet for a Mac because I was so tired of the equipment not working with the equipment that we had access to at the time. That's not going to happen this time. And so for those of you, I know I invited people to this retirement planning workshop, and I get there and the software doesn't work. The software does work. The hardware doesn't work. So I've got that all worked out now, and it's really simple to do. I really like this software. It's actually provided by BlackRock. You might know who BlackRock is. They're the largest asset manager on the planet. They're bigger than Vanguard and Fidelity. They manage more money than they do. And so they have a team of people that we work with there, similar to the people we work with at First Trust. And they provide an incredible amount of research. It's typically unbiased. And the reason I say that is that they have every product under the sun. They don't care which ones you use. They just, as long as you give them a shot, they're willing to work with us. And we get access to an unbelievable amount of research. I mean, these guys have really bent over backwards to try to help us out. Fidelity does that too, by the way. So does Vanguard. And so it's interesting. Those dynamics have actually changed over the years, whereas we might have been seen as a competitor in the past. Now we're kind of seen as a source of new business for these guys. So they're putting a lot of stuff out there for us. And this retirement planning tool that I'm talking about is one of the simplest and also one of the most effective. And I'm all in for anybody who can simplify anything. A lot of people don't like things simple. A lot of people like them really complicated. In fact, they're the ones I actually called them the complicators. They're walking around on the planet. You don't even know who they are. I keep trying to figure out how to. Actually, I can spot them now because I've been doing this for so long. But I'm the uncomplicator. I'm the person that likes to do exactly what's needed to do, not one step more, not one step less. I'm not going to take shortcuts, but I don't want to have to go and do a bunch of extra stuff. I'll give an example. When you're doing a budget, you have to have some wiggle room in your budget you're doing a monthly budget. And the people that already get this, I'm not telling them anything new. It's the people that are struggling with this, and they're generally pretty young. There are things in there that in your life that are going to happen. They're going to be unexpected. And so if you have a budget set out, you've got to weave that into the work that you're doing somehow to let yourself know that over time, certain things are going to happen. We call them emergency funds, and you're probably going to have to tap into that. And how much should you put in there? Everybody's got a different number. I've heard it, 6 weeks. I've heard 3 months, a year. Yeah, I think it's whatever you feel comfortable with. And that's something that if you're looking at it, if you're sitting down and talking to an advisor, they can run you through that relatively quickly. Somebody that's been doing it for a long time period, just taking a look at where your lifestyle is, how much your debts are, how much your income is, that's kind of easy to do. So if you've been doing it for a long time. So if you're young and you're struggling with that, then you should probably sit down. Now, if you're older, a lot of people that worked at jobs that have pensions and just had money taken out of their checks to go into their 401ks or their other retirement plans, 403bs, things of that nature, they really haven't bothered to do a budget because they've been putting money away, and money's been putting away on their behalf for their pensions, and they just live on whatever they got left, and which is fine. That's absolutely fine. But you may, when you get to retirement and you don't have that working income coming in anymore, and then you're relying on your savings, that's when you kind of got to know how much, you're going to be spending on a monthly basis. And you should probably start taking a look at that as soon as you can. I would take a look at it as soon as I graduated from college. But and quite frankly, I didn't do that. I didn't get into this business right away. And they didn't teach it in college. So I think I was in my late 20s, early 30s before I really took a super hard look at what all this stuff means. And when I found out, I was completely aware of the fact that inflation was the number one thing you have to battle against. People think it's losing all their money. And I got news for you. That can happen if you're really dumb, I shouldn't say that. Not really dumb. It can happen if you're really, really, really inexperienced. Okay. If you're super inexperienced, you can lose all your money doing something that you shouldn't be doing. Pretty hard to do, by the way. That is pretty hard to do. But you don't want to make mistakes that are easily avoidable. And me talking like this, this is hilarious. Just a thing flashed in front of my computer here, caught my attention, and just broke my whole chain of concentration. So I have to apologize for that. Anyway, we're talking about budgeting, planning, financial planning. I've got a tool we're going to be talking about. I'm going to show it to you. You can do a financial plan in less than 5 minutes. So I'm going to run through 3 different scenarios. I'm going to have 3. I'm going to have somebody that's just starting out, somebody who's in the middle, and somebody who's getting ready to retire. And I'll do each one of those in less than 5 minutes. So we'll only spend about 15 minutes. I always open up for questions after I do something like that. But that's how simple this has gotten. And it's amazing. It's really cool. I like it a lot. It's an eye-opener. So that's going to be a big portion of the seminar. And part of the whole thing about avoiding taxes is that your money grows faster if you're not paying taxes along the way. I think that there are a lot of instances where it's okay to pay taxes, just as long as you're aware. You just have to be aware of what you're doing. How does that fit into your goals? What are your plans? What are you trying to achieve? And the goals can be as simple as, hey, I think I need $5,000 a month. That could be it. That could be your goal. All right. How much money do you have coming in from Social Security? Do you have a pension? How much do you have in savings? How realistic is that? Maybe you end up having to have a part-time job, in retirement. But that's not a failure. That's a great thing to be able to do something that you really want to do, because you don't need to make nearly as much money. You'll be relying on your Social Security, your pension that you might have, and the assets that you've saved up. And by the way, I will never quit working. I'm going to be like Warren Buffett. They're going to take me out with my boots on. I forgot how old he is. Actually, I'll Google that during the commercial break. But he's in his upper 80s. and he works every day. And he's, I think he's like second or third richest guy on the planet. He's working every day. Do you know why he's working? Because he likes working. And I think that is something that we should start talking to our kids about when they're like right around 12, before the hormones kick in anyway, whatever age that is, because you won't be able to talk to them until they're in their mid-30s if you wait until the hormones kick in. Very, very difficult to talk to teenagers about this kind of stuff who are interested in a whole lot of other stuff. So bring your kids when they're 10, 11, 12. They're old enough to understand a lot of what I'm talking about. They're old enough to understand a lot of the math that we're going to go through that workshop. By the way, the workshop's at 8:30 in the morning because I have to come here and do the radio show after. So 8:30 in the morning, Tri-Cities Corporate College. It's a beautiful place. It's right over, actually just go to my website. There's a map to it right there. So you go to bullingtoncapital.com, go to the seminar tab, and you can sign up for it right there. There's no cost to attend. Seating is limited. Oh, and we are giving away, I have a Chromebook. And this time I'm going to do it at the beginning of the seminar so I don't forget. So we'll do a little drawing, a little Chromebook. Why am I giving away a Chromebook? Because a lot of the stuff that I talk about, you can actually go online and find. A lot of the services that we provide are done online now. We have a service for all of our clients that want it. I'm amazed how many people are not using this tool, by the way. But it is a dashboard, a financial dashboard, pulls in. This is what I love about it. I go in, I've got my credit cards and my checking accounts. Everything I pay bills out of is on there. I signed it up. I went through the authentication with the banks. I signed up the banks and the credit card companies so that it would bring my transactions in. Now, these are read-only transactions. Nobody can get in and steal anything. They can't steal my money because they don't have access to that. All they can do is see what's there and download it into this program. They can download past transactions. They can't make transactions with that. So I want to clarify that because a lot of people are afraid of this kind of stuff. And I have a feeling that's why so few people are using it. But this thing is invaluable. I spend 5-10 minutes a week going in, downloading every transaction from each one of those accounts into one spreadsheet. And then once I got in the spreadsheet, I can do whatever I want with it. I typically organize it, see where I spent what, classify it, and then save it. That's what I do. And then at the end of the week, I'll add another week's data to that, look at that, see if I see anything. And by the way, during the week, when I'm making transactions, like right now I'm having some work done, some repair work done, and big transaction goes through, it's over $500, I get an email right off the bat. It emails me immediately, hey, large expense alert. So when you're talking about trying to keep track of your spending and being aware that somebody might be using your account, which you hear about all over the radio and television. It's interesting. I've only had one client ever had a single problem with that, and it turned out to be relatively minor. But it can happen, and because of that, this service that we provide to all of our clients at no expense, incidentally, it's at no expense to them. That's covered under a management fee. No matter how much in assets you have, it's covered there. So it brings all this stuff in and really helps you get organized. And earlier when I was talking about the retirement thing, getting organized, figuring out where your budgets are, this makes it really simple to do a budget. If you've never done a budget before, you just get on this thing, download all your transactions for 3 or 4 months, 5 or 6 months if you want to go that long. And then you can take a look at them. You can see exactly where your money is being spent. That's a pretty good way. That's an excellent way. And it's kind of what I do. I know exactly how much I need to save each month to hit my retirement goals. And once I've hit that, I just spend the rest. That's how it works. That's my plan. Put the money away. How do I know how much I need to put away? Well, I did the math. I can't believe it's been 26 years ago. Anyway, I did the math 26 years ago. As in, I'm going to have to save X amount of dollars out of each out of the money that I get. And I had to estimate like crazy, by the way. Crazy estimations. Because I didn't have a job. I had a business. And all you business owners out there, you know exactly what I'm talking about. You get some unexpected expenses from businesses every now and then, but you also get some unexpected big wins. You get that big contract you didn't think you had a chance on getting. Woohoo! No, you hit those days. Now, the tough thing when something like that happens is to treat that as a one-time thing, to think about it in those terms, to put a big chunk of that money away. It's really tough if you're not very well financially versed or you're not tuned in to your personal finances. Just being aware, just awareness of where you are. And there's a lot of material written about awareness, and a lot of it, a lot of people think it's religious. It's actually not. It's a way of life for some people. It doesn't have anything to do with religion, but I mean, there's some similarities. Absolutely. Being aware of your situation, being aware of other people, being aware of feelings, all that kind of stuff. Yeah. So the financial awareness, just where are you? Where are you? What is your life like financially? That's not that easy to do sometimes. It should be, but it's not, because we all have accounts, spread out all over the place. And that's one of the reasons that I'm using this service, and I'm paying for it for everybody. I know I use it more than any one of my clients do, more than any of them. And it's just a great tool to be organized. Where are you right now? It doesn't have to be complicated. In fact, part of the tax avoidance thing is keeping it as uncomplicated as possible. Deferring taxes. I get a lot of flack from people who I think have their priorities a little bit mixed up. They don't want to pay anything in taxes, and what they end up doing is hurting their return, so they make less money to pay less in taxes. That is not a good idea. Even if I had a 90% tax bracket, if I earned $1 extra and had to pay 90 cents of it in taxes, I still have 10 cents. I still have extra money. Until the tax bracket goes to above 100%, I'm good. When it goes to 100%, then you're thinking, or if it goes to 100%, then you're thinking, well, it doesn't matter if I make this extra dollar, I'm going to give it away. Those don't exist. In fact, the tax brackets are a lot lower now than they have been in a very long time for an awful lot of people, especially if you're really rich. They're a lot lower. I hear the music. That means the whole first section of this show is already over. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. And we're back. You're listening to Bill Bullington right here on 1420 The Answer. I'm here every Saturday morning from 11 to noon. Also, you can find this show as a podcast on 955thefish.com if you'd like to hear it there, or you can go to my website, bullingtoncapital.com, and we post it up there as well. And I'm going to go to the phones, except that I can't find... Oh, the phone's moved on the other side of the desk. That's okay. I think I got it. Got to reach all the way over there. Anyway, and I've got John. John, you're on the Bullington Capital Report.
Hey, Bill.
Hey.
A couple stocks I want to touch base with you on. I've owned First Energy for years, and I don't know, for some reason it's almost up to what I bought it at. And is there something good happening there that wasn't there before?
That kind of stuff, it actually have to read through the company's 8Ks, what they're talking about, and all the research that's available on that. That would take the better part of an hour.
Yeah.
That's not something you can do in 30 seconds.
All right.
It's just
okay.
It's funny that somebody else was talking about First Energy the other day, just recently, and I haven't heard much about that company in a long time. Occasionally, it'll make its way into one of the dividend models, typically when it's gotten really beat up. But
Now, last week I'd called and I'd asked you about this coal company and you said, well, I'd have to check into it. I said, well, okay, and I'll call you next week. So here I am. Have you had a chance to take a look at? It's ARLP, Alliance Resource Partners Limited.
Yeah, that is one of the most complicated issues that I've seen. So I have to revert back to the just looking at their revenues and looking at the market cap. Kind of
okay.
The market value is $2.4 billion. Revenue is $1.79 billion. Their profit margins are all over the place. This company, it's a highly complicated structure. It's designed to generate an awful lot of income. It looks to me like it was it's a high risk situation. I'm sure that was not surprising to many people. With the dividend yield as high as it is, they're really trying to get as much yield out of this as they can. And when you do that, you're doing an awful lot of things financially that if you and I were to talk about it, we'll be here for 2 hours. And that will kind of get rid of every other listener on this show. But it's actually very similar. I believe it's it's a publicly traded limited partnership. I have to remember now. I know I went through it. The tax structure on this thing is incredibly complex. The management structure is incredibly complex. So it's just it's one of those things where I would look at it. First of all, Warren Buffett's got this folder or this container on his desk that he throws folders into, and he's got it labeled "too hard." If you have to think about it for more than 4 or 5 minutes, it's too hard, and that's where he throws all that stuff. This is one of the ones. That's what I would do. I would label this one "too hard," and if you really liked it, you would just buy a little bit of it. I wouldn't buy a lot of it.
Yeah. Well, and then the other category you could talk about is having a portion of your portfolio into. Because of high dividends or high yield, having it into more risky stuff,
Yeah.
That that kind of thing. But,
as long as you're okay with the amount of risk involved and you're not putting too much money in it, it's fine. I've got a lot of stocks I hold like 1 or 2% positions in, just because I really like them. I know there's a lot of risk involved, so if it goes away completely, it's not going to hurt me. But, a stock that has an 11% dividend that's publicly traded, when the average stock's yield is under 2%, if the yield on that stock got down to, say, 4%, it's going to be because one or two reasons. Either the price has gone up 2 or 3-fold, which is a good thing, or the earnings have come down so much and they're paying the dividend out as a percentage of earnings that the earnings have dropped really, which isn't such a good thing. So either scenario, if it works out really well, I go, yay, it made a little bit of money, maybe 1 or 2% for my entire portfolio, which is actually pretty substantial. But if I lose it, I only lose 1 or 2%. So not too bad.
Mm-hmm. Okay. Well, I thank you, Bill.
Well, thanks for calling.
Appreciate your input.
No problem. Have a good weekend. You
too.
Thanks. Bye. If you'd like to call 216-901-0945, 216-901-0945. It's amazing. I used to feel the same way about GE. I would look at all the businesses that GE was invested in, and many of them were not closely related to the others. And I was going, wow, how do you get your arms around that? I mean, how do you understand a business that makes jet engines, locomotives, and MRIs and sells long-term care insurance? I mean, how do you do that? It's incredibly difficult. So, in fact, it reminds me of Peter Lynch used to talk about companies, conglomerates like that would buy companies in various industries. And he called it diversification, because it's really difficult to be talented in all those areas. And you compare that to, say, companies like Hershey's that makes chocolate. Now, they make lots of different types of chocolate, okay? But those products are closely related. They're related. They've got more than one product line, but all the products are closely related. That's why I keep coming back to Hershey's as often as I do. And Hershey's has gotten off track over the years a time or two. They've done things that were outside of the food industry. Not often and not big, but which is a really good thing. And I'm not recommending that you run out and buy Hershey's, by the way, just because I like the chocolate and could probably keep that company in business by myself. It doesn't mean I think you should run out and invest in it. In fact, when you look at the market value on the company, the market value of their stock, it's $20 billion right now, and their revenue is only $7.6 billion. That is fully valued. It's not a bargain. Okay, it's not a bargain anymore. And last time it was a bargain, nobody wanted to own it. That was in March of 2009. It was $34. Now it's $95. That's pretty good. Yeah, especially for chocolate. No, actually, chocolate should be a really big premium. I can't tell you how many people I know that are just addicted to chocolate. So I happen to be one of those. You know what? We should start a group for that on Meetup. People are addicted to chocolate. We could share our chocolate recipes. Anyway, I'm kidding, kind of. By the way, feel free to call us 216-901-0945 if you've got a question, a financial question. Again, we're going to be focusing next weekend in the morning on the tax avoidance. And one of the things I did want to talk about there are annuities. There are good annuities and there are annuities that are really expensive. Okay, and if you've got an annuity, you might want to take a look at what your options are with that. That's something that we'll do with you at no cost. Okay, no cost. There are good products out there. There are not so good products. Or when I say not so good, I just mean that they're really, really expensive. And the expenses are so high that it makes it incredibly difficult to make any money. And so a lot of people have invested in those, not really understanding what they're doing, because a lot of the products, especially those types of products with all the extra fees, they're incredibly complicated. They're incredibly complicated. So a lot of people invest in them not fully understanding, and then they go by after years and years and they haven't really made much money. And that gets to be very upsetting. And I understand that. The products that we're talking about, those are not the same products. And to label all annuities are bad, I see some people do that. That's not, you're not thinking when you do that, because they're not all bad. There are actually some very good ones out there. But you got to be careful, because it's hard to tell the difference. It's really hard to tell the difference. And I'm telling you right now, this product that we're going to be talking about has lowest expense ratios in the industry. Think about that for a second. The lowest expense ratios in the industry. They belong to the product that I'll be showing you. And if you want to add all the guarantees and take a guaranteed income and all that, you can. Okay? But it's a choice. It's on a menu. It's a choice. It's on a menu. There are some of the annuity products that give you a choice. They give you menus, and you get to pick which benefits that you want added to it. They also tell you what the cost is of doing that. So, and a lot of people do pick the benefits, and some of them have done quite well, quite frankly, especially if the ones that started right around the late 90s, early 2000s, right before the stock market crashed. They've done better with their guarantees than they would have done had they left the money invested in that product without the guarantees. So, it's one of those things. There's a lot of information out there. Some of it's good, some of it's not so good. A lot of people are talking about it that really haven't read the entire prospectus, which is really a bear, by the way, because those things are generally several hundred pages. There are certain key areas that you want to go into and focus on when you're looking at that, mainly the areas that disclose whatever their fees and expenses are. And even then, it's hard to understand. So I get it. I really get it. I understand the hesitance to want to talk about it. But realistically, that I really feel like these products in the right situation is the right thing to do. And there have always been some pretty good product out there. And then there are products that they're just not that good. And what really, just to give you a little bit of history about that, annuities started off pretty competitively priced. And then as time went on and people were living longer and companies had to pay out more than they thought they were going to have to. Sound familiar? Anybody that's on a pension? Anybody that works for OPERS? Anybody that works for state teachers or has a state teacher's retirement pension? Sound familiar? You guys have to work longer now to get less money, and your cost of living adjustments not going up so much. You get to pay a higher percentage of your health insurance now. That's because people are living longer, and they didn't anticipate that the actuaries were actually using the calculations that were at the time correct, but the life expectancies extended. People were living longer. Health insurance, health costs have gone up significantly. Expenses in a lot of areas have gone up significantly, and the investment returns haven't matched what they thought they're going to. So they've had to make cutbacks. That's the same thing that's happened in the annuity industry. A lot of the older products, some of the older products are really good products. They're exceptional. Some of the products that have come along since then, since the years like 2005, the newer products, not so much. A lot of them, they have higher expense ratios because they're experiencing the same thing that these pensions are. People are living longer. They're having to pay out more. That's it's been really tough on them. So companies that don't have those legacy costs built in, if you sold a product to the public back in the early 2000s, late 90s, and people still haven't, it's still a good deal. You're being subsidized by the new people coming in buying product. It's just the way that whole industry, it's the way it works. That's the way insurance works. So it depends. What you have could be good. It may not be. And if you want somebody to take a look at it, we're willing to do that. Done a lot of work in that area. Not a problem. You can bring your stuff in, and within an hour, I can tell you basically what you have and whether or not there are options that you might want to upgrade to. And oftentimes there aren't. Oftentimes you've got a really good product. I'm going to let you know that. So we'll talk a little bit about that at the workshop, because you can really benefit a lot from not having to pay taxes on dividends and capital gains. When you have a regular mutual fund account and at the end of the year you get a 1099, it shows you dividend and capital gain. By the way, the biggest capital gains distributions typically come after a crash. I mean, think about that. Your money has dropped in value, and now you're going to get the benefit, the added bonus of paying a whole bunch of taxes. Got to love that, right? Let's see, with the if that were tax deferred inside of an annuity, you wouldn't be paying that. And that's one of the big misnomers, I think, is that they're all bad, they're all expensive. Well, they're not. They really aren't. In fact, Ken Fisher, he does a lot of I hate annuities, and they do the same thing I'm doing. They'll go in and look at your contract. And I've talked to several people that came into me after talking to them, and I didn't know they went to them after I said, no, you know what, I would keep what you have. They go, oh, that's funny. That's the same thing Ken Fisher said. There are some pretty good products out there. So feel free. You don't have to come to the seminar for that, by the way. You hear something that interests you, you can always go to my website, drop us a line. We'll get back to you as quickly as we possibly can. You can set up an appointment and stop by. Bring your stuff with you. We'll go through it together. I'll show you what we're looking for, and just how we do business. Not low pressure, no pressure. We give out more information than just about anybody I know. And I spend a whole lot of money on getting data for this kind of stuff. I mean, like a lot of money. Just for the data. Just so that I'll know. Even if it's just for me, I just want to know. What I know now is that I hear music playing. That means I have to go to commercial break. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages.
Got a ticket coming home. Wish the officer had known what a day today has been. Then I stumbled. Prison under open skies, everything.
And we're back. Hey, if you have any questions, phone calls, comments, feel free to give us a call or drop us a line. Go to bullingtoncapital.com to sign up for next Saturday morning's tax avoidance workshop. We'll be doing an 8:30 corporate college right here in Cleveland, Ohio. Actually, if you go to my website and you click on the seminar tab, it'll take you right there. You can sign up. There is no cost to attend. Seating is limited. And how many times am I going to do that today? Anyway, if you have a call, question, or comment that you'd like to talk to me about, feel free to drop us a line either on the web, through the website, or just give us a call at 330-664-0700, 330-664-0700. And, there are lots of different things that you can do to try to reduce taxes. I would tell you this, that most of the things that I hear, or I shouldn't say most, I should say a lot of things I hear will actually result in lowering your overall income. And I'm not sure that's the best thing to do because, again, as I was talking about earlier in the show, if you have to pay a higher level of taxes on a dollar's worth of income, and it's not that big of a deal because you still have the excess money left over that you wouldn't have had you not made that dollar. So, and I hear that a lot, and I know why. Actually, some people just hate paying taxes so much that they'd literally rather make less money. They hate paying taxes so much that they'd rather make less money. There are things you can do to lower the taxes and not have to make less money. And that's those are the things that we're going to be talking about. In fact, one of the services that we provide now, we just started this program less than a month ago, is we can take your portfolio and we can send it off to another partner firm of ours, Russell Investments. You might have heard of them, the Russell 1000. And they'll take a look at it, and they'll construct a portfolio that's tax efficient, one of the ones that they're managing. And by the way, to be able to do the things that they're doing, you've got to be huge. You have to have hundreds of billions of dollars in assets under management, because some of the techniques you just can't do unless you're that big. So we'll send it off to them. They'll come back to us with recommendations. We'll share that with you if you'd like to take advantage of that as well. You can get an idea of what you might be able to do and how much you might be able to reduce the amount of taxable income you have by paying attention to it and managing the money that way. So they're teaming up with us, and we're kind of the people that explain what they're doing. We tell them what kind of risk taker you are, what kind of portfolio you're looking for. We take a snapshot of where you are right now, and they'll analyze it, get back to me. We'll talk about it and go, yep, okay, that looks good, and then we'll present it to you. And you get the benefit of all that stuff, and there's no cost to doing that. So if that's something that you feel like you might want to do, again, either go to the workshop or go to our website. You can click on let me see. I think on every page there's a get acquainted, and it'll take you to the contact page, and you can just write your name in there, your email, give your phone number, whatever it was you wanted to talk about, and we will call you back. So, having said that, I really didn't get too many questions on individual stocks today. Actually, I only had one. That's interesting. There are some pretty attractive stocks that have been coming up on scans, and as most of you know that have listened to my show for a long time, I'll always do some things in individual stocks. I like looking at stocks that have good momentum and good value. That's a favorite of mine, but it's very, very, how should I say, disciplined. You've got to be extremely disciplined to do that kind of stuff. I still do it. Lately, I've really liked the more value-oriented things. I think that's it's a little easier, actually. It's a lot easier. In fact, one of the models I'll be showing you at the workshop is a model where I go in and I look at the operating income, or actually something that's close to the operating income. It's not exactly operating income, but basically I'm looking at a measure of cash flow, and then I'm going to divide that by the cost of buying the whole business. If I buy the whole business, what am I going to end up paying? They call that enterprise value. So if I take the earnings before interest and taxes, or a measure of cash flow, and divide it by the cost of buying the whole business, the enterprise value. I get a yield. So if I were the owner, before I'm paying interest on the loans or taxes, this is the amount of cash I'd be generating for every dollar that I paid for the business. That's basically a yield. If I was getting 5%, that's great. Is 5% as good as 10%? Nope. So if one's paying 10%, one's paying 5%, all other things being equal, if that's all I knew about the companies, I'd take the 10%. So, and by the way, if you do that on the top 1,500 stocks by size, just take all the stocks in the United States, take the top 1,500 that are publicly traded, listed in the United States, and you take all 1,500 stocks and you divide their operating income or their earnings before interest and taxes by the cost of buying the business, the cash flow by the business. It gives you a yield. You convert them all to a yield, and you just take the top 30. You could take the top 50. That works actually about just as well. So if you wanted to be a little safer, you would take the top 50. If you want to be more aggressive, you only take the top 30. When you think about it, there are only 30 stocks in the Dow Jones Industrial Average. So is it more aggressive? Not really. It's about, actually, volatility levels are very similar. But here's the thing. If I'm out there buying a business, wouldn't I want to generate the most cash I could from the businesses that I own? Doesn't it make common sense? And so if you do that, I think and you continue to do that, if you did it once every 6 months, that's the way I do it. You could do it once a year. When I ran the modeling on this, once a year didn't make quite as much money as doing it once every 6 months. But then you have the taxes, and since there's about a 30-40% turnover in the portfolio every 6 months, and taxes, it was almost a wash. So I decided to take the higher returns, pay the higher taxes, make the same amount of money. So it was almost a wash at the end of that, by the way. So that was very interesting. Now, you can't guarantee any of this stuff into the future, by the way. We're not allowed to do that. Whenever you're doing anything, the past is the past. It may not repeat again, and probably won't repeat exactly the same way. That's what gets people into trouble. They think it's going to repeat exactly the same way, and then it zigs when they thought it was going to zag, and next thing you know, there's a little problem. Now, that happens no matter what, by the way. That's going to happen no matter what you do in markets, even when you're doing something like I'm doing, when you are using math instead of your emotions or logic to pick the stocks, and you're basing them basically, essentially just on how much cash they're generating for every dollar that you're paying. You're going to buy some companies that will actually end up losing money over time. That's going to happen. That's why you don't buy just one. 30 is pretty concentrated. That's actually pretty concentrated. 50 is concentrated. 50 is considered concentrated today. But if you had 30 stocks and it made up less than 30% of your portfolio, which it probably is going to, so you'd have less than 1% of your money in each one of those stocks. So in other words, you can afford to have a couple of duds in there. It's not going to hurt you that badly. That's a big step in the right direction. Knowing that you can be wrong and it's still not going to hurt you is a big deal. Psychologically, I think it's a big deal. When you look at it monetarily, I know it's a big deal. And it's really the right thing to do. You're behaving with intelligence. You're being an intelligent investor that way. Look, when I bought it, it looked great. It had a yield of 10%. The cash flow went down. The yield dropped. I had to get rid of it. No shame in that. You can't know the future for sure. And even if you could, or even if you thought you could, I was laughing about that the other day. There were these guys back in the, I think it was late 80s, early 90s. They were trading on inside information. Okay, these guys are insiders. They were actually trading on some of the stocks that they were helping restructure. So you hire these guys, investment bankers, they're going to help you restructure your company. They're taking all this information that nobody in the public gets to see, and they're buying and selling the stocks based on this information they have that nobody else has access to. Well, they got caught, and they banded them from the securities industry, give them big fines. A couple of them went to jail. And what was amazing is if you added up all their gains, they were actually negative. They were losses. They lost money. So that's how hard that is. The public doesn't always react. The investing public. When I say investing public, I'm talking about all the funds out there. The investing public doesn't always react the way that you would expect them to. And you'd have thought that these guys, these big insiders, the big Wall Street tycoons, would have correctly anticipated the reaction to the news. And just goes to show, anything can happen and probably will. And you've got to prepare for that. You've got to prepare for that. I hear the music. That means I got to prepare to get out of here. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420. Also available as a podcast on 955thefish.com, or you can go to my website, Bullington Capital, and download it there, or iTunes. We're all over the place now. Anyway, have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.